welcome to TheoTrade. This is Don Kaufman. June 25th, 2021. Minutes to go to the cash close here in this week of trade. Are markets displaying inefficient behavior? That's the topic of conversation on this weekend's update. We're going to get right to work on that front, taking a look at the S&P futures, which, you know what, for an extraordinarily boring week of trade, I'm sorry, but anybody that trades on an intraday basis, yes, the markets absolutely unequivocally went higher. But again, if you do trade on an intraday basis, there were some extraordinarily slow points to the marketplace throughout the course of this week. In fact, one other aspect, and the reason I wanted to start with the S&P futures, take a look at some of the volume that's been done out there. So say what you will about a marketplace that did absolutely explode to the upside. Look at the volume. This is where we're currently at. Again, there are 13 minutes left to your trading week. Yes, that's where the volume is. You have to go back into half a trading sessions like on Christmas Eve to see volume this light, people. Just wanted to make that point. So there's just not a huge amount, if you will, of hedging activity going on. There's not a huge amount of intraday trade effectively going on. However, you know, with all that being said, we need to talk, and we're going to talk right up front, okay, about markets starting to display some inefficient behavior. And I can absolutely not stress this enough that I've done some significant research on this particular front. In fact, I'm going to take you into some of that research. So to understand about efficient or inefficient behavior, we'd have to look at something called expected moves. So we're going to cruise over to the SPX, the mother of all products, and we're actually going to go into the daily chart of the SPX. I'm going to go ahead and I'm going to close up this left side bar because I want to make some just really, you know, definitive statements here. What you're looking at, again, on a week-to-week basis, we measure expected move. An expected move, okay, represented by these three lines, is what the option market depicts risk to be moving forward. Right at the end of today's trading session, we'll already be able to denote what the expected move is for the coming week of trade, right? But the expected move, if you will, this past week of trade, the week that's ending here in the next 10 minutes, we had an expected move of plus or minus approximately $90. What was the actual move? So this is your, again, your expected move, and this is the central part. This is where the week starts. This is the upper edge of the expected move, the lower edge of the expected move. Actual move, well, at least at this point in time, I mean, you're looking at it's about 110 SPX points. So this is where you say, all right, if you look at expected move, an expected move, okay, is this nice distribution curve, and you say, well, you're supposed to move up $90 or down $90, you know, you shouldn't be like awestruck by the fact that we move 110. We're just a little bit outside of what was, if you will, expected. So, all right, push that one aside because you know what? Sometimes you break outside the expected move. Again, the expected move is, you know, 68% of all occurrences, except we're breaking through the expected move, okay, on a larger than normal anticipation of movement. Again, a $90 expected move, that's put on your big boy pants. It's a big move, and we smash through it. And it's also following a previous breach of expected move. So the previous week, we were looking at, you know, we were supposed to have about a $50 move, okay, but we smashed through it. Okay, the week before that, nothing. Okay, the point that I am trying to make on this particular front, okay, is we're starting to see the marketplace, if you will, come apart a little bit. And here's some of the research, okay, that I've actually done on this front. So I can actually go back into hand-drawn expected moves. And that's actually what you're looking at here on my SPX chart. And this is something we share with every single TheoTrade client. And I'll actually knock my time frame all the way back to, for instance, like 5 years. And I'll show you that I've been tracking expected moves right until back here, okay, which is early 2017. Now that's specific to the SPX. That's the hand-drawn expected moves. However, at the same time, we have a study called auto expected moves. So we've actually looked at, you know, expected moves back many, many more years than 5 years. Okay, so this is 5 years and it's week-to-week data. And one of the things that we've actually picked up on quite considerably has to do with periods of wild efficiency, then leading to periods of inefficiency. And I'm just going to highlight something. And again, I'm doing this a little bit off the cuff, but here we are actually all the way back. And again, let me denote the exact date. This is coming into 2018. This is like, summer of 2018 coming into fall of 2018. What I want you to see, though, is the incredible period, if you will, of efficiency. Week after week after week after week, we're seeing inside the expected move, inside the expected move, inside the expected move. And then all of a sudden, breach, okay? Breach. All right, we get another breach, a breach, a breach, a breach. All these highlighted aspects are breaches of expected move. And what we've actually found is that consecutive breaches of expected move, okay, lead to more breaches of expected move. It's actually partially, you can look at this in this terms of like serial correlation. And that effectively means that, you start ripping apart, through volatility and it continues. And I'd be a little concerned at this point because, again, this is the crux of why I'm talking about inefficiency in the marketplace. So we break expected move last week, but this week we shattered expected move in this week on a really big anticipation of movement. And here's the part that just kills me, okay? And this is important. It's not just the SPX doing this, and the SPX is the marketplace that I would say carries the most in definitive weight. Come to the other products momentarily. The part that really, really gets me with the SPX starting to break through expected moves again, the next 7 days, this is next Friday's expected move, the volatility is already collapsed down to plus or minus $53 and change. So I don't know exactly what the expected move is yet for the following week because this market is not technically closed, right? It's still moving around, but you're looking at plus or minus $53. So what the marketplace is saying at this point in time is, hey, don't worry. We just had, this is a move from roughly 41.66 all the way to 42.86. So it's actually, apologize, I said 110 points. You're at a 120 point move inside of the S&Ps. Okay, so the actual movement's more than 110. Huh? Okay, so it's 120 point move in the S&Ps, except this next week they crushed the expected move back down to what? Plus or minus maybe $53. Are you kidding me? So we're saying that we're going to move, okay, less than half of the actual movement of the previous week. So all of a sudden, again, all right, I am looking at this and saying like there's a degree of inefficiency in the marketplace. And this is where, first of all, you can take advantage of this. But secondly, I mean, there's all kinds of implied volatility style trades in here in the short duration. Effectively, it means buy short duration options, sell longer duration options. Okay, but push that aside for a second. It's the marketplace starting to break apart a little bit. Okay, and this is something that you don't necessarily know. Okay, with 2 consecutive breaches of expected move, if this is going to be it. But again, previous to that, it has been a very long time since we've seen a decent breach of expected move. You got to come all the way back to April. Before that, another brief move, crack of expected move, and another brief crack of expected move over here. But it's been a very, very long time. And again, consecutive breaches of expected move tend to happen, okay, in sequence. So you get one breach, another breach, another breach, and that's exactly, okay, what I'm trying to portray is very likely for this marketplace. Now, that's not per se going to give you any directional bias. Nevertheless, if you actually look back, historically speaking at this, breaks to the downside followed by breaks to the upside led to more breaks to the downside of the expected move. It's almost a pure 50-50 out there. And today, again, with 4 minutes to go to the cash close, yeah, we're going to actually breach the expected move in a big way here inside of the S&Ps. But it's not just the S&Ps, okay, doing this. And I just can't stress this enough. When I talk about like inefficient behavior, like, do you understand? There are billions of dollars being traded in this expected move. And when the expected move is wrong, I mean, literally you're saying like, hey, the marketplace, it got it wrong. Billions and billions of dollars are wrong, and they're wrong one way, and then they're wrong again, and then they're wrong sequentially. That's the thing with inefficiency in the marketplace, and it can actually reign large for quite some time. Let's cruise over to some other products though. Let's go look at the IWM. So in terms of the IWM, which is the Russell, we'll cruise into expected moves as well. Take a look again at the Russell. A massive breach to the downside last week, a massive breach to the upside this week. And this is massive. I mean, this is, a deviation outside. It's 2 deviation move, another 2 deviation move. It's a party out there, people. I mean, the Russell is becoming downright wicked. Doesn't stop necessarily at the Russell as a product. Okay, I think you would be remiss to not necessarily mention, of course, the QQQ. So, of course, I'm going to drop into the Qs. Take a look at the Qs. The Qs, okay, not exactly a large breach recently, but we are actually breached to the upside. The Qs, right, which is, of course, the Nasdaq is actually the most mild of some of the breaches. The XLF, downright wicked right now. The XLF is one of the largest breaches that we've seen in recent history. The XLF, and again, we're talking about inefficiency in the marketplace, if you will. XLF options, they got it wrong 1 week. They got it massively wrong. Okay, the second week, you're 3 weeks in a row. And again, this is exactly what I'm talking about. Like it's not just cause for concern. You realize that, again, a marketplace that's trading billions of dollars is literally saying, no, we're getting it all wrong over here. That's the XLF. Take a look a little bit further down the list and some of the usual suspects, and you'll come to the energy sector, which is the XLE. The XLE, wicked breach to the downside last week, breach to the upside. Okay, a recent breach even prior to that. Again, the marketplace very well could be shifting for a period of efficiency into wicked inefficiency. Last but definitely not least in this front, probably one of the primary reasons that I wanted to bring this to your attention. How often do you actually see the SPX, okay, the IWM, the QQQ, the financials, the energy sector, and check this out, TLT, the bond market, okay, the bond market as well, seeing very, very similar breaches of expected move, okay, and how many consecutive weeks? All right, you've got 1, you've got 2, you've now got 3 weeks of a breach of expected move. Okay, that is, again, a bit of a tell to the marketplace. So I think you should anticipate at this point in time that, next week, even if the expected move says, for instance, $53 inside of the SPX, which it absolutely does, okay, I think you could anticipate even more movement than, if you will, that $53. Okay, and there's going to be, again, some fairly wild moves, which we'll come back to here in a moment in terms of trading strategy. 1 minute left to play in the period. Now let's cruise down a little bit. So if you take a look at markets, and again, kind of giving you a bit of a update on the market, rotation and bifurcation might be making a little bit of a comeback. I'm going to talk about rotation and bifurcation. Okay, what we're actually referencing in this particular concept here is the financials. Okay, we saw for weeks of time, the financials versus, for instance, tech. Okay, and financials and tech have actually been moving in high correlation. I'm going to say that again. Financials and technology have actually been moving in correlation, which means they've been moving in unison, right? Here's big tech rallying. Here, okay, are the financials kind of continuing to rally until, again, they have diverged, and they have diverged significantly. But if you look at just this couple of last few days of trade, the financials once again are breaking back to the upside, okay, with, all right, tech actually displaying degrees of weakness. And here we come to the closing bell. All right, it's over, people. It's over. So there seems to be a bit of rotation and some bifurcation making a bit of a comeback. And this is going to impede upon not only markets, but it's going to impede upon your ability to read through the advanced decline line. And the advanced decline line still looks stellar over here. But you realize, like looking down the list of some of the usual suspects, people, what matters in the marketplace is down. I mean, even Amazon's down like, 1.4%. The monsters of tech are actually down. Not significant, but it might appear that there's a rotation and a bifurcation. Now, why would that be? Okay, are rising rates going to be making a comeback? Like, is that going to be the big issue in here? All of a sudden, okay, this trading session and this trading session alone, you're seeing interest rates actually pop back to the upside. So rates are actually popping back to the upside. I want you to watch this and watch this very, very carefully through the beginning of next week. If rates continue to the upside, bottom line, rates go to the upside, okay, it's actually going to take down tech once again. So you're going to be talking about like interest rate issues. Last week, what was the issue last week? Inflation, except during a period of inflation, the rates, ironically moved down. All of a sudden, you get this big bid back under rates. I think if rates got all the way back up to the 1.7% level, all right, you're going to have issues, big issues in tech. Keep that in mind. Rotation, okay, bifurcation. All right, that is due to this rate issue. Next, on the docket over here, we got to look at stress tests. So the financials have a very strong bid under them. It's very likely due to the Fed stress test. All of your banks passed with flying colors. You're going to hear a lot about banks and buybacks. Enough said on that particular front because I think it's predominantly priced in. Why do I think it's priced in? I mean, take a good look at, again, auto expected moves. We are, 2 deviations outside. So those of you that are looking for the banks to start announcing like huge buybacks and so forth, absolutely, unequivocally they are. But again, very large part, I think that is priced in. Now I'm going to come to the dark side of the force over here and look at the dollar. Okay, the dollar has actually been a little bit perplexing as of late. The huge bid under the dollar, okay, in previous weeks of trade was due, I believe, to risk coming into the marketplace. One of the things, though, that I think you have to have respect for, okay, is, again, I have dollar, what I call reservations. The dollar explodes back to the upside and then just flattens out, okay? At this point in time, I'm still a believer the dollar's actually got room for movement to the upside. That, though, that is unequivocally, and at least in my opinion, a bearish take for the marketplace. I mean, when you start looking down the screen over here, though, that's really like one of the only things that's, hideously bearish is that the dollar is absolutely ripping strong. And again, I believe that any continuation to be a bid under the dollar, all right, is going to put a nail in the coffin for the S&Ps and the Nasdaq for a larger degree. But this, to me, looks like hedging. This actually looks like, traders, they're hedging and they're hedging everywhere. And we're going to discuss that here momentarily. Now, with the dollar trade, and again, my reservations about the dollar, I believe the dollar is still going to appreciate to the upside. With my reservations about the dollar, I thought it was appropriate also just to throw in here, for a brief and fleeting moment, let's talk a little bit about crypto, because one of the things that surprised me about crypto at this point is it hasn't actually bled over to the broader marketplace. I think that the 30,000 level holds a huge amount of weight. I mean, you are looking at a marketplace that has gone legitimately down by 50%. It was at 60,000 a couple of weeks ago. It's now trading 30,000. Okay, one of the things, again, it has been isolated at this point in time. Again, there are cracks forming in here, and I think 50% is more than a crack. It's more of a fissure, but there's cracks forming in here. I think under 30,000. You're going to start to see tech impeded upon to a larger degree. Specifically, you're going to look at stocks like Nvidia. All right, and I'm actually relatively surprised. Not only has Nvidia held up, okay, Nvidia has actually exploded back to the upside. A couple of wild days in here when crypto got a little bit crazy there. But again, Nvidia could be on the dance floor for some sell side activity. It does have a split coming in here, neither here nor there. Look at Nvidia, though, this next week of trade if crypto is to actually break under the 30,000 level. Onward and upward. Volatility dropped, but tail risk is a still wagon. One of the main themes I think it's being missed over here is people are talking about, oh man, look at the VIX. The VIX is all the way back down. It's like the lowest point the VIX. Yes, this is the lowest point VIX has been since the onset of COVID. Right? So you go back and you got to go back now, almost a year and a half, and it's the lowest point of the VIX. Newsflash. Okay, the VIX. This is like my predecessor's volatility indicator, because what you're going to find out is the tail risk is a still wagon. What does that mean, that tail risk is still wagon? So let's start with the VVIX. The VVIX came off, okay? But the VVIX is actually still rocking north of 100. Like the VVIX at 110, duck and cover, get under your desk, be afraid. So the VVIX is still relatively high at the 105 reading in here. Okay, that's not like of critical importance like it was at 130, but it's still indicative, okay, of some hedging. What else is indicative of hedging? You'd have to look at Skew, and this is what I say the tail risk is still wagging. Skew is through the roof. Now, Skew is only updated once a day. All right, but Skew has been record high. For the last 2 weeks, it's been record high. So what that amounts to is out of the money puts are still trading for absolute record premium. So even though we look at this and we look, oh man, volatility is dead. Really? Volatility is dead, huh? Because the out of the money premium has never been higher, and it hasn't. And that's one of the things you want to keep conceptually in your head. Volatility dropped again, but tail risk is still displaying. Last but not least on that particular front, something that I watch very, very carefully is the differential between front and back volatility. And here's where I'm going to give you guys a very, very harsh warning. Okay, here's your harsh warning. If you sell near-term premium, you are out of your mind. Look in the index products, it's short-term premium. It is insanely low. I mean, for the next 7 days, right? Next 7 days, you even have an employment situation coming out next week. That's right. Job report is coming out next week. We're riding on less than 11% volatility. You got to be kidding me. The spiders are only looking for a $5 move. I'm not selling that. Look at the volatility, though, towards the back month. The back months out here, 84 days, 97 days. These things are still up in the 18, 19%. But wait, there's more. What's the more? Yeah, I'll tell you exactly what more is. Go look out of the money. And you can see I've got a bunch of positions out here, right? Let's go look out of the money. Let's actually look at implied volatility. You want skew, people? Because there it is. The out of the money puts are still trading at like 40% implied volatility. Now I'm way out of the money, but it's neither here nor there. Look, I have positions in here, okay? You know what? You can sell a crap load, a proverbial crap load of out of the money options right now, and you're able to hedge in the VIX dirt cheap. You got to think about that. It's a huge catch-22. If you're not seeing skew for what it's worth, you're missing the big picture. You sell front month premium, you're going to get killed in this marketplace. All right, so onward and upward. Let's look at front and back month premium. Specifically, we're going to look at decay in the Christmas tree ratio spread that I have on. And to do that, I'm actually going to cruise over to my monitor tab here. And inside of my monitor tab, what I want you to look at is specifically in this spider position, okay? Because this, I really think that this kind of accentuates exactly what I was talking about just a moment ago with, maybe sell some back month premium. Here, take a look. This is actually an option that I'm long, meaning I've actually purchased this option and I'm down about 23%. But the option that I'm long is a 420 put, which is very close to where the spider is currently trading. It's only $6 out of the money, right? So this option is only $6 out of the money. It's down 23%. Then I went and actually sold back month units. But take a look at the differential. On the option that I bought, I lost 23%, but the further out of the money options are actually decaying at a much more substantial rate, and their percentage gains are considerably higher. Hence why I'm actually selling 3, 4, and 5 of those. That ratio spread, though, okay, should give you a little conviction, if you will, on the decay of near money options versus the decay of far out of the money options. The out of the money options are decaying at a much more substantial rate than near money options. Not to mention, there is unbelievable skew to be able to sell in those back month options. Last, again, but definitely not least, we come back to the SPX expected move. Again, the mother of all products. As I said, the trade this next week for me, and I want to get really, really specific over here, I am very likely to be a net buyer of some short-term premium, okay? And I'm going to finance that by having sold back month premium. Why? Because I think in the near-term options, I am sorry, but that implied volatility, this is like a Monday expiration. It's 6%. Okay, there's just no way. I mean, 6%. And in fact, if you take a look at the at-the-money options in here, look at the at-the-money options. Okay, they're what? They're under 5% implied volatility. It's insane. They're saying that absolutely nothing can happen between now and Monday. The world cannot blow up. It will never blow up. It is incredibly low, though, implied volatility at that point. And I'll tell you, these are the type of options, a couple of days out that are worth being a net buyer of. And you're going to finance those by selling options further out of the, in terms of date, and further out of the money in terms of skew. Now, one last look over here is, again, we had priced in a $90 expected move in this previous week of trade, and we smashed it. I mean, we literally, again, 120-point move inside of the S&Ps. Next week, the SPX, that move is not exactly set for next week, but look at this. Next week, we're looking at about a $54 move, which is exactly half of the price action that we got from the previous week. So again, I warn you, do not sell front month premium. Do not sell front month premium, because that marketplace is, again, it's extraordinarily tight in the front month, and you're seeing signs, if you will, of inefficiency everywhere. I want to thank everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.